Okay, so chapter 3. Let's pull this up. All right, so in chapter 2, what you saw was a situation that's probably highly unlikely, but it was a good illustration because you had an acquisition happening on the last day of the fiscal year for parent and sub. And so when you're doing your consolidation on the same day that the acquisition occurs, you don't have any subsequent events to deal with, like what you'll see here in uh, chapter 3. So it's a good illustration from that point of what the parent would have to do in that unlikely scenario is simply uh, reverse in order to consolidate the parent and sub's financials on the worksheet. They would simply have to back out by debiting the sub's retained earnings, paid in capital, and excuse me, paid in capital, additional paid in capital, and retained earnings. So it would be your debit, and then the corresponding credit would be to the parent's investment in the sub account, whatever that sub's name is. And so that equates to the book value in the net assets of the company. Or if you want to look at it this way, the net value of the parent's investment in the sub. So that's the S entry. The A entry is the allocation of excess value, excess fair value to the identified assets that have excess fair value. Or, in some cases, the fair value might be less than book value, so you have to deal with that. And of course, that's your debit mostly. You'll see a situation coming up where it's actually a credit, but for the most part, the excess fair value stuff is going to be a debit, and then, of course, the corresponding credit is the remaining balance of the parent's investment in the sub. So that's the excess fair value part of the investment account. All right, so remember what you're doing here. This consolidation stuff is for external use, external reporting of the consolidated combined companies. Now, the passage of time creates other issues. And for bookkeeping purposes, especially on the parent's financial records, remember that for consolidation purposes at the end of the year, they're doing this worksheet to consolidate the financials of the two companies, but they keep separate accounts, separate accounting systems, and so this passage of time creates internal record keeping situations, and the balance of the investment account on the parent's books varies depending on what happens. And of course, we'll look at some different accounting methods. These different accounting methods account for different things. For internal record keeping, the parent has some different options on how they want to account for this investment in the subsidiary. The three most common are the following: the equity method, the initial value method, and the partial equity method. Now, the equity method is just like what you saw in Chapter 1. With full accrual accounting, you record your investment initially. When the subsidiary earns income or reports earned income, the parent records their portion of the sub's income. So that would be an increasement in their investment account. And of course, the offsetting credit is equity in subsidiary. Now, dividends create a reduction in the investment in the subsidiary, and then you have your excess amortization that reduces the investment account as well. So, full accrual accounting is the equity method, and we'll be looking at that one mainly, but let's talk about the other two just briefly. The second method is the initial value method or cost method. Simply puts the cost of the investment on the books, and no adjustments are made except for dividends that are declared. So the parent doesn't list any subsequent income, their portion of subsequent income in the sub. They don't have to deal with any of this excess amortization stuff either. Just simply report dividends as income. Partial equity method, they would, if you're using the partial equity method, they would, the parent would report their portion of the sub's income every year. So that would increase the investment account, and then any dividends declared would reduce the investment account in the sub. But as far as any of that excess amortization and all that other stuff, they don't deal with it. So here's kind of a rundown of that. Shows the advantages, and the method that a company uses is kind of based upon what they look at as far as measuring performance of the sub. If they want a full-blown performance based upon accrual accounting, they're going to use the equity method. If they want to have something less than that, they might have their own performance measures. They probably would want to go with something that is going to create less of a problem when it comes to consolidation. Now, we're going to concentrate on the equity method. Your assignment will be using the equity method. It's the most difficult of the three. Sorry about that, but I figure if you could do the equity method, you could do any of these other two out in the real world if you had to. So remember that the method adopted affects only the separate financial records. It has no impact on the subsidiary's balances, and it does not affect the amounts reported eventually on the consolidated financial statements to external users. Now, you're going to have different entries depending on the method you use, but that's the only difference. All right, so here's an example, and so we're going to look at all the entries you would have to make if you're using the equity method. All right, so Parent Company obtains all the outstanding common stock of Sun Company, and they purchase it on January 1, 2017. Parent acquires the stock for $800,000 in cash, and so if you look below, the net book value of the assets acquired and liabilities assumed is $600,000. The fair values of all those assets acquired and liabilities assumed is $720,000. You can see the differences there are obviously $120,000. And so, you just eyeballing that, you can tell that you've identified the assets that have fair value over book value of $120,000. So the excess payment made by Parent to Sun is due to goodwill. And so notice that trademarks are $20,000 more than its book value. Patented technology is $100,000 more, and so trademarks have an indefinite life, so there's not going to be any excess amortization on that. It's just going to sit on the books. Patented technology has a 10-year remaining life, so that's going to have to be, that excess of $130,000 is going to have to be amortized over the remaining useful life of 10 years, so $13,000 per year. And then here with equipment, you've got a situation where you're going to have to you're going to have negative amortization, essentially, or negative depreciation. Again, in the book, they use the term excess amortization to include both amortization and depreciation, so don't be confused by that. So anyway, the $30,000 is going to have to be a negative amortization amount of $6,000 per year for 5 years. All right, so you might, so you know what you're allocating things to. You might go through this excess fair value allocation method. And here, like I said, here's your excess amortization per year. Now recall in intermediate accounting, probably when you dealt with a premium on bonds payable, you had a situation where the carrying value was more than the face value, and over the remaining life of the bond, you had to actually do negative amortization to get the carrying value down to the face value of the bond. And so that's what's happening here with equipment. The negative amortization actually creates a benefit by reducing the amount of annual excess amortization. All right, so here's the entries that would be made on Parrot's books. Now, the $800,000 for 100% of Sun's stock must have gone to the shareholders, not to Sun, because Sun is not making any entries here. This is Parrot's financial records, not Sun's. But just for the record, there would not be any on Sun's because they didn't get anything. It all went to the shareholders. All right, so personally, so the initial entry for Parrot would be this entry at January 1. Investment in Sun Company is your debit, and cash, of course, would be your credit. Now, here's the subsequent events that occur. On 8/1/17, there's a dividend declared of $40,000, so they debit a dividend receivable of $40,000, and they reduce investment in Sun Company by $40,000. On 8/8, they receive the dividend receivable, so they debit cash and credit the dividend receivable. And then on 12/31, Sun Company earns income of $100,000 for the year, and so Parrott debits investment in Sun Company for $100,000 and credits equity and subsidiary earnings for $100,000. And then the excess amortization entry simply reduces investment in Sun Company by $7,000. So your debit is to equity in subsidiary earnings of $7,000, and credit is to investment in Sun Company. So the net effect is they increased their, well, really, I mean, they started with 800,000, they decreased by 40,000, so they're at 760 as of 8/1, and then it goes up to 860 on 12/31 once they make the 100,000 investment debit, and then it goes down by 7. So what, 853 after all these adjustments are made to the investment in Sun Company account. All right, so for consolidation purposes, you've got to do the following 5 entries, maybe 6, that we'll talk about. There's a 6th one. Now, the 5 here can be thought of with the acronym SAIDI, or the name SAIDI. SA, that you're familiar with, and then DIE or IDE. Some books use SAIDI, SADIE, easy to remember. This book uses SAIDE, not sure why. But either way, it's fine with me, I don't care. All right, so the first 2 are things you already know how to do, hopefully. The S entry is eliminating the subs stockholders' equity accounts, beginning balance, and the book value component of the parent's investment account. And the A entry recognized the unamortized allocations as of the beginning of the current year associated with the adjustments to fair value. So you're adding all those excess fair values to the assets that they're attributable to. And of course, your credit is going to be the remaining balance in your investment in sub account. Now, the 3 other entries are I, eliminating the subs income accrued by the parent, D, eliminating the subs dividends, and E, recognizing the excess amortization expenses for the current period on the allocations from the original adjustments to fair value. All right, so here's the entry S, simply taking the shareholders' equity off the subs books. And again, this is on the worksheet, not actually taking it off their books, but you know, it's like you're doing that. You're just doing it on a worksheet, not their actual financial records. And the offsetting credit is the book value of Parrott's investment in sub company of $600,000. The entry A, we're simply allocating the values, excess values, to the assets that they're attributable to. This is what caused Parrott to make a purchase price for more than the book value of the assets. And so 20,000 allocated to trademarks, 130 to patent technology, 80 to goodwill, And of course, you have a situation where equipment's less than its fair value, so you have to uh, credit $30,000. And of course, the difference is the remaining investment in Sun Company after entry S of $200,000. All right. Next entry, consolidation entry I, is the net effect of the two entries that we recorded earlier, the $100,000 investment in Sun Company and less the excess amortization of $7,000. So the net effect is $93,000, and we simply reverse that entry that we made on our financial records. So we debit equity in subsidiary earnings, $93,000, and credit investment in Sun Company. So that zeroes that out. The entry D is pretty simple. You're simply reversing the dividend declared. So it's simply a reverse entry of credit to dividends declared and debit to investment in Sun Company. So that's pretty easy. And last but not least, in entry I, part of that entry was this excess amortization of $7,000. So you got to come back in, and in your consolidation entries, account for the excess amortization. Now you can do this a couple of different ways. Here, they're combining these. Your debits are amortization expense 13, and of course you're adding back to equipment for the next 5 years $6,000. So that's your other part of the debit, and then your credit is $13,000 to patent technology. So you're reducing every year for the next 10 years patent technology by $13,000. And here's your negative amortization, or in this case, negative depreciation. So you're actually crediting depreciation expense. Now you could simply make two different entries here. You could debit amortization expense 13 and credit patented technology for 13, and then do a separate entry for equipment if you wanted to. Again, that's kind of up to you how you want to do that, whatever helps you. Okay, the only other entry is when you're going to have what they call intra-entity receivables and payables. And so if you look on page 101 of the book, Exhibit 3.7, and let's see where they talk about this. They actually talk about it on page 102, consolidation entry P. And so the scenario is Sun has a $40,000 payable to Parrot. So Sun has a payable, Parrot has a $40,000 receivable. And so simply what you want to do is, let me get to that, the following. You want to, and again, in the consolidation records, current assets, they have current assets, but it's not broken down. So there's nothing that says receivables. It's just part of the current assets. So you're going to credit current assets for $40,000, and then your debit here in the consolidation records, they just list all liabilities, current and long term. And so to back out a liability, you're going to debit $40,000. So that's the only other entry that you have to know about. All right, so entries CDP are the entries that you need to know, and once I would do these entries separately, And then once you've done them separately, you would come in on your consolidation worksheet and identify where those go in the worksheet. That would be the easy way to do it. All right, so that's it for the first part. Next part of the lecture will be dealing with the goodwill account and how you determine impairment of goodwill, and also impairment of other intangible assets.